Greetings, comrades. Here we've got a bunch of revenue accounts. We're at the end of our reporting period. We've got a bunch of credit entries and we need to close these accounts off for two reasons. We're complying with the period assumption, which requires us to divide the life of the business into finite periods in which we measure the performance by deducting expenses incurred from the revenue earned so that we have comparability of our performance over time. But we also need to zero off these accounts so they're ready for the next reporting period. And this is where the P&L summary account comes into place because it helps us facilitate the closing off of our revenue and expense items. So when we have an increase in revenue, we credit the accounts as we've done here. So now we need to zero these off, close them off. So therefore we do a debit entry to each of them, and our temporary account that helps us facilitate this is the P&L summary. So be careful in your terminology. Make sure that we don't just call it profit and loss, we actually call it a summary accounts. So our three revenue accounts, if we total it up, and it's called a P&L summary for a reason, the summary of all of that revenue is 3820. Now, if we were required to do that in the GJ, we debit our revenue accounts to zero them off, and we do a single entry to the profit and loss summary for the grand total of 3820. A narration, if required, you just cite the memo that you're working from. Okay. What about sales returns? Do we group that with expenses? No. Think about where sales returns are reported in the income statement. It's part of the revenue section. Cash and credit sales less sales returns equals our net sales. So therefore, we're going to close this off with our other revenue accounts. So debit entry to our trading revenue, credit sales, a credit entry to the P&L summary for our sales returns. Work out your net sales, 8K minus 200, and therefore we're going to close that total 7,800 to our P&L summary. So in your GJ, a debit to your trading revenue, a credit to your sales returns, negative revenue, and therefore we need a 7,800 credit entry to our summary account. Same drill with expenses. We need to close these off so that they're zeroed off for the next reporting period, and this will help us determine our profit, and hence we have the comparability of our results over time, and therefore we're complying with the period assumption. So we've got a bunch of debit entries during our reporting period to these expenses. So now we need to close them off, zero them off. So therefore, a credit entry to all of these, cross-reference with our profit and loss summary, and then total up those three expenses, and you'll get 4410. So all of these accounts have been zeroed off, the revenue and expenses. In your GJ, again, this kind of goes against the grain because normally when we have an expense, we do a debit entry. Here's the exception. These are all credited, and therefore we have a debit entry to our temporary profit and loss summary account. So if you're ever asked to complete a revenue, expense, or even drawings ledger, this is how you go about it. You record all of your debit entries if it's an expense or a sales return, or credit entries if it's your standard revenue, total that up, and then we do a cross-reference to profit and loss summary with a matching amount. Double line it just to signify that it's been closed off. Careful with your cross-referencing. Don't just call it profit and loss. Make sure we emphasize profit and loss summary. That's the name of the other account affected. But we're not done there. We also need to close off our drawings because we're going to report our drawings for the period so that the users of reports have relevant information about the impact of the owners taking out assets of the business against the profit and how that affects the owner's residual claims and the net worth of the business. So given drawings is negative owner's equity, we'll have some debit entries, and so therefore we close it off to the capital account with a credit, and so therefore that reduces our OE. The P&L summary is a temporary account. So now we need to close this off at the end of each period. First of all, we close off our revenue and expenses, and then we need to top up the smaller side. So in this case, our expenses exceed our revenue, so therefore we're going to need a credit entry to our P&L summary for the difference, and this represents our net profit or loss. In this case, it's a loss because expenses exceed revenue. If it was the other way around, we would be topping up the debit side of the temporary account, and we'd have a credit entry to our capital. So total those two up, and we've closed this off because we have matching totals on both sides, and now we can do another debit entry to our capital account. So all of that needs to go through our GJ. So we did a debit entry to capital and a credit to drawings to close that off, and then we did another debit entry for our capital for the loss, and now we've closed off our P&L summary. Keep in mind that when we are preparing our balance sheet, the owner's equity section, we're going to start with our capital balance, which will exclude those closing entries for drawings and net loss. And then we're going to report our drawings and net profit or loss so that we provide relevant information to users of reports, and we make our balance sheet more understandable in terms of the users and their interpretation of our financial position.